travel to meet all of our clients, to meet with our teams. And I'm very grateful and privileged to speak to you today as a leader of this wonderful organization. From all the sessions I've had, the meetings I've had, I found that it's an organization that is respected by clients for the quality of the services and the caliber of our talent. We have embarked on a turnaround phase in TechM's evolution, and we are actively making foundational moves to upgrade our performance. The overarching goal that we have in this phase is to make the investments and the changes to maximize our long-term earnings growth, to drive a culture of performance in both delivery and in sales. As we shared previously, we're in the process of defining our long-term strategy, which will then be effectively implemented to give the long-term value for our customers, for our employees, and for our shareholders. In the previous earnings call, I had shared the fact that we are embarking on 3 tracks to unlock the value from our operations. The first track is for sales improvement, or the revenue growth track. The erstwhile organization structure at TechM, comprised of 12 sales SBUs, which we have now simplified to just 6 units. We have also eliminated the dotted lines. We have delayered the hierarchy for better synergy and for accountability. The portfolio companies are also being integrated under the respective business units for better realization of the synergies. We also scanned through our portfolio and we saw a need to reconsider how we allocate time and investments across our overall client portfolio. What we found was that there was a low investment focus on our top accounts, and I think this has resulted in our not realizing the true value of these very significant clients that we have. At the same time, we have found ways to substantially improve and to better utilize our efforts in engaging across the smaller clients as well. So, in a nutshell, we are bringing more attention and investment to the top accounts, and we are revamping our efforts to engage with the smaller accounts. These actions are going to improve the effectiveness and the efficiency of our sales efforts. So that's on the overall revenue plan. The second track that we shared is for margin improvement. Historically in TechM, as the delivery teams were aligned to the regions and they were spread across too many units, there was a lack of central ownership, leading to a lack of scalable, innovative, and industry-focused solutions. We have now moved to a centralized delivery structure for IT services, which helps us foster innovation and domain expertise, but also helps us implement focused programs directed towards cost reduction and margin expansion. In my 7 months over here, I found that at TechM, the quality of the delivery talent is very strong, and our staff really have an intense desire to serve clients. By combining this strong talent pool that we have, which significantly improve delivery structure and processes, I believe that TechM will further enhance its client service while also increasing our innovation, profitability, and scalability. In addition to the plan for revenue and a plan for margins, we are also working on a plan for the organization. TechM historically has thrived under entrepreneurial growth, and this has fostered an informal culture. The intention now is to combine this agility, but also to take a look at the frameworks and to make sure that we are able to implement changes and to move quickly. The organization structure over time had become hierarchical and siloed, and I truly believe that a company of this size needs robust processes and frameworks, so there is room for freedom and for creativity within the set framework. We've made changes to our internal policies on these lines, and there is a lot more work that is happening in these areas in the months to come. For an organization which is as big and as diverse as TechM, I think it's important to progress from an entrepreneurial model into an organization with a unifying vision and supporting frameworks. We have also just recently concluded a cultural assessment using an independent assessment firm, and the final report has identified an encouraging set of cultural strengths. And these strengths, as you can imagine, are around customer centricity. They're around a sense of belongingness and a pride in the company's heritage, in the group's heritage that we have seen. But the studies also highlighted some areas where our organizational practices need to improve. And in that regard, the key improvement opportunities really include elevating the roles of our delivery organization, which I believe that the centralization will help put that into place. It has also identified the need for improving the consistency of our associate rewards and the consistency of our feedback processes. So based on these inputs, right, and these inputs were a set of surveys, detailed focus group sessions, the collective feedback of our leaders, we are working towards establishing and really building on the culture of the company, building a further culture of performance, a culture of professionalism, learning and merit. We have already started making changes to our incentive schemes and to our HR policies to reduce the bureaucracy and to empower the workforce. And I believe that by diligently embarking on these three priority areas, right, the plan for revenue, the plan for margins, and the plan for the organization, I'm very confident that we have all the strengths that it needs to pull off this plan. As I have repeatedly said, the strengths of the company lie in our talent pool, in our client base, and the very strong heritage of the company and the very strong heritage of the group. We are a market leader in CME and in manufacturing, and I believe we have strong emerging strengths in banking and financial services, healthcare, life sciences, and retail. We have a fast-growing BPS business, and we have distinctive capabilities in IP, in engineering, and in AI. So I believe that we have the foundation, the merit, the talent, the values, the ability to achieve all our goals, and I don't see any hurdles that stop us from becoming really the best technology services company in the space. So building on these strengths along with the focused efforts on the areas of improvement that I mentioned, we're embarking on a turnaround effort that will take TechM to the next stage. The primary objective of this turnaround effort is to maximize TechM's long-term revenue growth and long-term margin. Doing so will require substantial changes. It will require some turnaround costs and above normal investments over the next year. And to underscore this, especially given the multi-year opportunities we see, we will use this turnaround period as an opportunity to invest to significantly improve our positioning in a set of target markets. We've also worked to onboard a significant set of leaders, and the previous quarter was in a sense a quarter of new beginnings. Richard Lobo, as you know, has joined us as our new Chief Human Resources Officer. Rajshri has joined us as the Chief Growth Officer for the Americas Strategic Verticals. Piyush Dubey has joined us as the Chief Marketing Officer. I had already previously announced the joining of Atul Saneja, our Chief Operating Officer, Roshan Shetty and Pankaj Kulkarni as our BFSI heads in the US and Europe respectively. In addition, we have also strengthened the leadership to scale the BFSI vertical in Asia Pacific and the ANZ region. And I want to take this opportunity again to welcome them to Tech Mahindra. They are significant additions to the team, and I'm sure that they will bring great value through their rich experience and domain expertise. I believe that we already have a great team in place at the helm, and with these new additions to the TechM family, we should be able to take this organization to the new heights from already very strong foundations. So now moving on to the Q3 results, we report revenue today of $1.573 billion for the quarter ended December 2023, which is a growth of 1.1% for the quarter sequentially, and a decline of 5.7% on a year-on-year basis. As we look further into the segments, the growth in the quarter was mainly driven by our strengths in the manufacturing sector, where we continue to leverage our history and our deep expertise in the automobile and related ER&D services. We are also seeing an uptick in the retail segment during the holiday season, and that played out this year as well. Outside this, most of the other segments like CME, like BFSI and high-tech were impacted by furloughs. We have reported EBIT margins for the quarter at 5.4%, which is an expansion of 65 basis points. These numbers are the outcomes of actions that we have taken to de-risk the portfolio. Once you adjust for these exceptional items, the operating margin stands at about 7%. We report new large deal wins TCV at $381 million for the quarter. This comprises of deal wins across our key segments. And just to give you a few examples, we were selected as the strategic IT transformation partner by a prominent life and annuities provider in North America. This is a large, multi-pillar, comprehensive transformation engagement that includes the modernization of the core through cloud migration, application services and infrastructure services. Telecom was also selected as a strategic partner by US-based telecom OEM for building and operating their next-gen state-of-the-art lab in Plano in Texas. We were chosen as a partner of choice by an American package and supply chain company. The portfolio transformation deal includes a scope of work across application development and maintenance, enterprise applications, cloud, next-gen data analytics, AI machine learning, as well as digital design. Tech Mahindra has also been selected as a prime services partner by a US-based telecom operator. Telecom will provide transformative design, development, management and support services for the ILEC stack. We have been selected by a large Asian bank for a comprehensive digital banking CX deployment servicing their customers in the region. So you see a range of wins across geographies and across vertical areas. Just to spend a little bit of time now on the progress that we're making from an AI perspective. And we have seen significant progress on the Gen AI front. We launched the Vision Amplifier, which is a solution which infuses Gen AI in computer vision. It provides an end-to-end workbench to substantiate computer vision use cases. Earlier, we had launched the Email Amplifier and our Ops Amplifier. So this is our third offering in the Amplifier suite. We currently have active client conversations related to Gen AI, and we see early stage experiments and POCs now starting to move into production pilots. Many of these engagements are in the areas of conversational AI, document AI. Gen AI, as you know, is an integral feature of large transformational deals as well. And we have also seen standalone Gen Eii deals. These are in areas as diverse as enterprise knowledge search, customer engagement, business process management. In terms of industry segments, healthcare and life sciences, stands out for me as an early adopter of Gen AI. I think we are seeing specific interest in areas like drug discovery, EMR, and medical audio scripts. We're also helping hyperscalers and SaaS providers to scale their AI offerings. We see the emergence of complex use cases of Gen AI applications in areas like chip design. And to maintain our lead in this space, we will continue to train our associates with Gen AI-led skills. And we intend to enable this for 100% of our talent base. Currently, we have trained over 16,000 associates, and the coverage will increase as we move forward. This is for pair programming. A much larger number of people have broader Gen AI and AI training. Finally, from an awards and recognition perspective, I'm happy to announce that Tech Mahindra is the only Indian company to make it to the Dow Jones Sustainability Index, the World Index 2023, part of the DJSI World Index for the 9th consecutive year. We've also been recognized as among the progressive places to work in 2023 by ET Edge. Now, having given you the broad general overview, I want to hand it over to Rohit to share an update on the financials. Over to you, Rohit.
Is it audible now? Yeah. Okay. Thanks, Mohit. I'll just share the financial results in detail for the quarter. So we ended the third quarter with $1.573 billion US, which was up versus last quarter by 1.1%. When we break it down into comms and enterprise, communication vertical declined by 0.3%. Enterprise grew by 2% on constant currency basis. And when you kind of look at this growth, we had certain one-time revenue in the quarter because of which we got some upside. If you normalize for that, we are flat versus last quarter. We did have some positive impacts due to seasonality in retail business and our Comviva business, which was offset by the negative impact we have at year end due to furloughs. In terms of large deal wins, our TCV wins was at $381 million. From a margin and profitability perspective, we ended up at $84 million at EBIT level, which was up from $73 million last quarter. The margin percent hence was 5.4%, which was an expansion of 65 basis point QOQ. As we mentioned last quarter, we continue our journey on looking at the portfolio, rationalizing certain businesses where we don't want to be long term. Based on those actions, if you normalize for that impact, our EBIT margins of the quarter is at 7%, similar to the normalized margin last quarter. Moving below EBIT, our other income for the quarter was $11 million, which was down versus $32 million last quarter. Forex losses was $5 million versus break even. We either had a loss or a gain last quarter. In terms of ETR, we were at 22.8% this quarter. We made the PAT at $61 million, which made the profit margin at 3.9%. In terms of free cash flow, we had a great quarter. We declared $228 million of free cash flow, which was 2 consecutive quarters of more than $200 million of free cash flow. When you look at the DSO improvements, we saw 6 days of improvement in the quarter, which got our DSO down to 91 days. We do expect the cash flow conversion to normalize in the next quarter, but for the year, we'll still be looking at a very healthy cash returns. In terms of the hedge book, we ended the year December 31st at a 2.3 billion hedge book versus 2.5 the previous quarter. As you know, we follow the hedge accounting policy. Based on that, at a mark-to-market gain was around $5 million. 2.8 of that is taken to the P&L, the rest goes to the reserve. We stand at cash and cash equivalent of $843 million as of 31st December, which is healthy from a balance sheet perspective. And as mentioned earlier, we've taken a series of action this year from Q2 and Q3 from our portfolio, both on the top line and bottom line. And result of these actions are resulted in a lower reported earnings, but we are pretty confident that as these actions give us long-term benefit, you'll see the return of that in the future quarters and years to come. So we now open to take questions. Abhilasha.
Thank you, Mohit and Rohit. We will now conclude this stream. For those who have joined us on social media, thank you everyone for joining us. We will now open the conference for a Q&A session for media friends who've joined us virtually and are present here. Those who have joined us virtually can please post their questions in the chat box. We'll start with the media here. If you can please say your name and the publication.
Hi, I'm Rachna from CNBC TV 18. I'd like to ask about reported EBIT margins. They're at 5.4%. What's the outlook for Q4? Apart from that, how much of the reorganization is complete and how many more quarters of margin pain do you see will continue?
At a normalized level, the 5.4 is a reported number. As I mentioned, the normalized margin is at 7%. So as you look forward for the current quarter, I think most of our actions are kind of closed. We're still looking at certain portfolio companies, and as a part of the annual process, we'll keep on looking at impairment and the requirements on how they are going to give future results for us. So that's a part of the annual process. But outside of that, most of our actions are done. As you look forward, our Q4 should be a normalized margin of 7% and above. But as a guidance, we usually don't give that. But that's the baseline that you should look at.
Okay. Additionally, if you could shed light on why have deal wins come down to $381 million from $640?
Yeah.
I think, look, there has been a slowdown, especially in the sectors where we are strong. In telecom, we saw continued weakness throughout the previous calendar year. And these things are also a little bit lumpy, right? By its very nature, large deals can sometimes move from one quarter to the other. That's all there is. Sort of a general slowdown, especially in the sectors where we are strong, and the delays that we're seeing overall. I also think that we are being more prudent and selective in the deals that we do, given our focus. That would be an additional factor.
Speaking of sectors, there's been muted growth in communication, BFSI, and high tech. When do you see recovery in these sectors?
That's not even $1 million question. That's a $64 billion question. I think if anybody could forecast when the recovery would happen, would take more than a mere tech services CEO to predict that. Look, I think it's very hard to to tell when the markets will pivot. Certainly, it seems that the consensus seems to be that the second half of the calendar year is when people will start to see an improvement, and I don't think the recovery will be simultaneous across geographies and across sectors. Maybe for BFSI and for healthcare, we'll start seeing green shoots in 6 to 9 months, and for some other industries, it could take longer.
Sure. Lastly,
sorry, I'll just have to be cognizant
this
of
is
time.
the last question. Your outlook on attrition. That's it.
Yeah, look, I think we've had a very good track record on attrition, and compared to our peer groups, we have performed better, for the past year or so. Attrition has remained low. There is a slight tick up that we are seeing, especially in deep technical skills, and I think it's a sign of as the market improves, we see attrition coming back a little bit.
Sorry, Aishwarya, before you start, the next question I'll take online. This is from Ayushi Kar. Can you add a bit more color on the standalone Gen Eii deal secured by Tech Mahindra in terms of size and the kind of deals?
Yeah, so look, like we said, a lot of these are, initially proof of concepts and experimentations that we are now seeing move to production stage. Just to give you a sense, we've been working with a number of telecom companies to deploy Gen AI chatbots for digital deflection. We're also using Gen AI to reduce the power consumption in networks. We've used it for retailers as they look to reshape their catalogs. We worked with auction houses as they look to reimagine their art. We're looking to bake it into many of our large deals. So, for instance, a lot of our large deals have developer productivity and overall productivity using AI, and we're baking it into our our service lines, right? We're working with ISVs to incorporate it in their offerings. So it is now very comprehensive, right? It is very comprehensive and baked into our large deals, baked into our service lines, as well as standalone deals, right? So that's the sort of the additional flavor we can provide.
Hi, sir. This is Aishwarya from ET Now. You mentioned about the turnaround effort and some sort of big investments coming in. Could you shed a little bit of light on how much, what the figure is, and the timelines?
Sure. So look, I think, like we said, we are in a turnaround phase of the company, and we are working on the plan for revenues, which is going to be the focus on the sectors, the service lines, the geographies. There are multiple levers that we're looking at from a margin perspective. And there is the investment we have to make within the organization, right? Whether it's in terms of learning and training or in terms of marketing and brand building. We have not quantified the exact amount, and like we had shared previously, April is when we come back to you and expect to present you with a snapshot of what the early cut of the plan is looking like, and then maybe share details with you as we go through the year.
Is there a range you can talk?
It has been exactly 33 days since I've been the CEO, so hopefully not too late it's not been so long that a plan is overdue.
All right. In terms of growth, you've been lagging behind as compared to other peers in this particular sector. Do you think it has finally hit the bottom, or should we see an uptick from here?
No, look, I think our growth has been challenged. I think part of it has to do with the sectoral distribution of our revenues, in the sense that we have the highest exposure to telecoms, which has been a segment that has seen challenging growth, not just for us, for everybody. But as the sector comes back, as we focus on service lines, as we focus on our strengths and capabilities in other sectors, I do believe that we will come back, and that is what the turnaround plan is focused on. It is focused on making sure that our margins and our growth achieve parity with the peer group. So that is the intention.
All right. In terms of furloughs, will that extend into Q4 as well? And are there any early signs?
So there is, in furloughs, especially in geographies like Australia and especially in sectors like high tech, there is for the first 2 weeks of January as well, you do have a furlough impact. So we do expect some sort of an impact in the current quarter as well.
Final question. You said you've just completed about 33 days. So going forward for the year of 2024, how is it going to be different from 2023?
No, look, I think, like I said, we're building on the foundations of a very strong company. We have a great talent pool. We have a great client base, and we have a very significant amount of support from the group, which has very unique capabilities. We are looking to streamline the organization, which is why we've done the reorg. We are looking to invest back in the organization in terms of brand building, in terms of training and learning, in terms of our infrastructure. We are looking to sort of invest in our service lines. So this is how we're looking to to build the organization through the investment and growth, through the focus on margins, and through the organization. And the outcome will be in terms of revenue growth and margins.
The next question is from Veena Maji. Are you going to colleges for hiring this year? If yes, how many will you be hiring?
Yes, we will be going to colleges for fresher hiring. The exact numbers we have not shared yet. We'll be sharing those in April.
Haripriya, you want to go? Sorry,
Yeah,
Tushar.
sorry. Hi, gentlemen. This is Tushar from NDTV Profit. In the statement that you put out, you talked about a dichotomy in the quote that you put out. So you have growth in manufacturing and healthcare, but there is pain or weakness in communications, BFSI, and high tech. So do you see this dichotomy widening in the year ahead, or do you see a retraining of focus on BFSI now that you are here because of your background? Secondly, on expansion of that, how are your conversations with clients now that they may have set their budgets? So what is the sense you're getting from them for the demand environment? Mr. Anand, for you, just one question. What is the strategy on the margin recovery? I think you have spelled out as part of the 3 tracks that you said. But in the near term, how do you want to go back to those top tier margins that you had about maybe 3 or 4 quarters ago? Thank you so much.
Sure. So I think, look, on the on the sectoral distribution, the thing that I'll mention is we are still seeing volatility in telecom. We are not seeing spend come back in a very significant way, but I do believe that the worst is behind us, right? In terms of just the very strong drops that we saw in 2023. This doesn't mean that we will not see near-term volatility in this quarter or the next quarter, but it does seem that the magnitude of the challenge that we saw in 2023 will not, again recur in 2024. As far as BFSI is concerned, I do feel that we are underrepresented in that sector, even though, compared to our peer groups, even though we do have $1 billion plus practice. So we will continue to, what we're doing just now is we're looking at the various assets that we have from a BFSI perspective, where we've got, for instance, our transaction processing capability in Target. We've got very high-end consulting capabilities with Citisoft. We've got digital engineering capabilities with CTCO. And we obviously have a broad set of relationships across the globe with banks and insurers. So we're taking this together with the new team that we have, building a comprehensive storyline. And I'm confident that over time this will have an impact and we will be able to build a larger business from a BFSI perspective. To your question in terms of client conversations, I think that while compared to maybe 6 months ago or 9 months ago, there is more optimism in the client base. It's too early to say that there is a sort of a turning point or a tipping point where things are looking more optimistic. No, I think it's too early to say that we are seeing green shoots. In any case, like I mentioned, even when we do see green shoots, right? Look, it is not going to be like the COVID era, right? Where you saw a global sort of push into technology across sectors, across geographies, across client demographics. Everything was booming, right? Even if there is a turnaround, the expectation is that it will be limited to a sector or limited to a geography. So there isn't going to be a everything boom like we saw 2 years ago.
Yeah, so on the margin standpoint, as I mentioned, our normalized margin is going to be 7% EBIT right now. I think from there next year, we will definitely see an uptake. And as Mohit said, we will also carve out certain investments that we want to do for long-term basis, because you've got to look at, from a turnaround perspective, it's few things, right? You make certain portfolio choices that we stick on for the next 3-4 years. You also make some long-term investment that we stick on for next few years, and some of the long-term investments are needed right now to give you the benefit, right? So we're taking a little bit of a longer-term view versus just this quarter, next quarter, what do we need to drive it. So I think it's a long-term shareholder value creation. And in that context, the idea is what's the best thing for us to do to, once we lay the foundation, organization, which Mohit already announced, the team is in place. As we go level deeper, culture, all the other stuff that we're going to be doing, agility on the processes, we try to do all that. With that, how do we sustainably get improved margin and a better growth position versus just looking at short-term profile. So we will improve definitely next year, but the quantum of that will be in balance to keeping long-term view in mind.
Good evening, gentlemen. I'm Haripriya from Reuters. I looked at the geographical breakdown, and I see that rest of the world has sort of declined about 11.3% year on year. I know sequentially there's been a growth, but I wanted to understand, is that something you're looking at de-risking from? Are you looking primarily on focusing on Americas and Europe? What is the strategy there? Is there any particular geography you're seeing pain in? And if you can sort of elaborate on the demand in America and Europe as well. Also, you mentioned substantial costs and investment, right? Do you expect, is there like a timeline on how many quarters you expect to see this before, expect to invest before you start seeing any return or not? Thank you.
You want me to talk about geography? So from a rest of the world perspective, some of the actions we've taken are directed towards that because some of the portfolio was not long-term aligned with where we want to be. So we have taken that decision that's reflective in the growth, degrowth that you see. From a long-term vision perspective, our focus is going to be from a concentration perspective, increase our mix more in US and Europe. That's the intent over the next 3 to 4 years. And that's where our investments will also be guided towards. So that's kind of where we are moving from a direction perspective. In terms of demand and other drivers, maybe you can talk.
Yeah, and the only thing I'll add to that, right, is look, it is not like we are defocusing from the Asia Pacific business, right? I just want to clarify that. Because within the Asia Pacific region, we have a very strong franchise in Australia, right? We have a very strong franchise in Japan. We've got an absolute jewel of a business in Singapore, and we've got a wonderful business in Indonesia, right? So we are looking at selectively, growing in these markets where we have opportunities. So I just want to make sure that we are taking a very strategic approach towards the markets where we invest and where we put in our dollars, and these are all very important markets for us. Markets where we are marginal, for instance, right, where we don't have very significant capability, like Papua New Guinea, for instance, right, we will not be looking to invest in those markets. And as far as sorry, what was the other question?
The demand I want to get demand color on America and Europe and on the investment in terms of a quarter timeline.
Yeah. So as far as demand is concerned, look, I feel that manufacturing, again, we have seen through the cycle has been quite steady in the Americas. Healthcare, there are certain actions that we have to take in Q4 which will have an impact. But otherwise, healthcare has been reasonably robust for us in the first 9 months of the quarter. I don't think there is any specific BFSI Europe versus BFSI US color to it. Quite honestly, it's very, very client specific.
Sorry, investment in terms of the number of quarters.
It's too early to share that assessment about. Like I said, we're building out those plans, and the plans will have their own investment profile. But what we wanted to clarify to you, as Rohit mentioned, that we're looking at this as a long-term business. We're not looking at making any quick fixes. We are looking at investing for the long term because this is we feel that this is a wonderful franchise, and over time we should be able to deliver really steady returns to customers. But we do really want to build steadily rather than get quick hits.
Debangana?
Hello, gentlemen. This is Debangana from Money Control. Just to add on to Haripriya's point, I wanted to get a sense of, US elections are coming up in 2024. So is that kind of factoring into your customer conversations? The second thing I wanted to get a sense of is your hiring plans. So last quarter there was a addition, you had added net new addition was there quarterly, and this quarter the headcount has again gone down. So wanted to get a sense of the hiring plans, also just a sense of how do you plan to end FY24 in terms of fresher hiring.
And in terms of discretionary spending, so since 2024 has already started, do you expect any recovery? Probably in which pockets are you going to see the recovery happening first?
So look, I think as far as the numbers, the overall numbers are concerned, I believe that the reduction is largely from a BPS perspective that we have seen this quarter, which reflects the seasonality of that business linked to the holiday season. Otherwise, it is linked to the overall revenue, sort of the revenue that we have for the quarter. As far as the the hiring is concerned, we will be hiring, like I mentioned, fresh graduates, through the year. That's a significant portion of of our plan to to bring in fresh talent and to invest in training for new capabilities. We don't have a detailed sort of hiring plan for FY25 that we're sharing at this time.
Ramita, you have a question?
Sure. And on the
Can we take this offline? I'm being cognizant of time. We'll take it after the call.
Just a couple of questions around the in the leadership changes. You mentioned Roshan and Pankaj are leading some different markets for BFSI. What is Vivek Agarwal's role going to be here?
Vivek is looking at strategy for the group. That's his role, and he continues on his existing responsibilities of looking at M&A and a couple of other corporate responsibilities.
Okay. And you had mentioned last quarter about the breakup of leadership between JPAC and EMEA and US. You have obviously announced Rajeshri and Harshavendra's roles. Who's heading EMEA for now?
EMEA is Vikram Nair.
Okay.
Shivani?
Yeah, hi.
I must commend you on being so well informed.
Yeah. Yeah, hi. Hi, Shivani from Business Standard. Mohit, a couple of questions on the restructuring. Communications, as you've said, is kind of slow. From a strategy point, where do you see telecom/communications? 35% as of this quarter. That's the share in it. Do you see that coming down? Is that a strategy that you're looking at?
Yeah. So look, I think the communications vertical is really the the lifeblood of the company, right? It is the heritage of the company, and I do believe that we have unique capabilities and unique skills in the sector. I was actually in a client meeting in Davos, right, where a very senior telecom executive actually said to his CEO, saying, nobody understands the telco business like TechM does, whether it's on the network side or on the front end side or all the OSS, BSS stacks. We have a unique understanding of it, and we're also able to bring in capabilities like design, like Gen AI, in a very robust fashion to this market. We also have a very strong telecom software business in Comviva. We have a network services business which none of our peers really have. So I do feel that we have a unique capability to offer to this market, and it will continue to be very significant for us. I'm making sure, Atul Saneja, our Chief Operating Officer, is making sure that we are investing to keep our cutting edge in this business from an IP perspective, from a domain expertise perspective. And we remain very relevant to the 300 plus operators that we work across the world. It is just that the sector itself has been struggling from a revenue perspective, and our performance is more indicative of the sector challenges rather than any specific TechM gaps.
Right. Just sticking to this sector, telecom has had structural issues, and this has been happening for a couple of quarters now.
Yeah.
So from that point, do you see, and as you said, BFSI is something that you want to grow. It's a big business for you, more than $1 billion now. Do you think there is room for probably to maybe reduce some bit of telecom? And the reason only I ask is because of the structural issues that the sector is facing, and probably you want to bring down that dependence from that sector.
Yeah. No, we are not looking to bring down or to reduce the telecom revenue at all, and telecom will remain very, very central to TechM. But if you look at the normal trajectory of of TechM as well over the past 5 or 6 years, the percentage share of telecom in our revenues has declined, right? And that is because other sectors have grown faster. And at some point of time, it is going to normalize with our peer group, right, where other segments are bigger. So it is just a natural process of evolution as we grow our business and as we hit a certain size or scale.